Hello and welcome to another episode of Market Masters. My guest today is someone who's seen more market cycles than most of us have had hot dinners, but is still as curious, sharp and excited about the future as any first-time investor. Mark Mobius, the legendary voice of emerging markets, joins us once again. He may have decades of experience behind him, but his forward-looking views still make headlines. Mark has also authored a book. It's called The Book of Wealth, A Young Investor's Guide to Wealth and Happiness. It blends in investing insights with reflections on financial well-being. Mark, thank you very much for coming back on this program.
Pleasure being with you. Thank you.
Mark, before I start, let me just quickly recap some of your some of them out of consensus calls, right? And I'm going to list 5 of them, and then we'll sort of dive into how your thinking has evolved on some of the big issues. Number 1, Mark's call was India will overtake China as the world's second largest economy over a matter of time. It is a matter of time, according to Mark. Number 2, US manufacturing is coming back. It's powered by AI and automation and not cheap labor. Number 3, and this I found as sort of Mark as one of the lone voices when he made this call. He said US deficits may shrink and not explode. He was referring to, of course, tariff revenues. Number 4, and again, this is completely out of consensus, non-consensus, dollar will strengthen according to Mark. Number 5, China's official data can no longer be taken at face value, it is suspect. So those are the 5, sort of big calls, views, whatever you want to call it, but those are which kind of sort of stayed with me since Mark sort of spoke about them. Mark, thank you very much once again. A lot has happened since the last time we spoke. There's this 50% tariffs, which now, of course, have become reality. And it's kind of a waiting game between India and the US. It doesn't look like either side is going to blink. So I just want your thoughts on, why this has happened and what's the end game here? 25% base tariffs and 25% tariffs because of Russian oil.
Well, I think, Trump has gotten exasperating news from Russia. There hasn't been any decline in the situation in Ukraine, and this has made him very, very frustrated. So he's taking it out on India. He's hoping that India will help. But I'm afraid his hope is going to be shattered because obviously India doesn't want to give up its imports of oil from Russia. And at the end of the day, even with the big tariff increase that you're talking about, it will hit the exports from India. Maybe 40% of exports will be hit. And most important thing is that the big sectors that are going to be hit in India are the high labor content sectors, the jewelry, gems, garments, that sort of thing. Unfortunately, that will hit a lot of people, a lot of workers that need jobs in India. So hopefully the government can do something to alleviate this difficulty. But it must be remembered that pharmaceuticals, electronics are off the list. They will not have this tariff. So those exports will continue to the US. So the impact on India from a GDP point of view is maybe 0.5%, at most 1% hit on the GDP. So when you look at it in the big picture, it is not going to be that big an impact in terms of the growth in India and in terms of the health of the Indian market.
Right. Mark, did I hear that correct? You're saying Trump will be disappointed if he thinks this 50% tariffs will work with India. I mean, he'll get what he wants by imposing this 25%. You don't think it will?
No, I think he will be disappointed. Now, of course, we've seen Modi holding hands with Putin. That is not going to be very encouraging to Trump. So obviously, the U.S. is going to have to step back. And I think probably they will begin to realize that India is not going to give in to the pressure. So I think Modi has given a clear message to Trump that he will not be pressured. And I think for good reason. I think India has got to stand up to this kind of imposition in terms of trade.
Yeah. But so what's the end game here, Mark? I mean, this 50% surely cannot be permanent.
No, I think they will have reached an agreement. I would give it maybe 2 or 3 weeks, and you'll see the U.S. coming to the table again and negotiating something with India, so that this is not going to take place. India may make some small concessions, but at the end of the day, it'll be the U.S. that will have to step back.
Okay. In your assessment, because this is a bit of an overhang, in terms of percentage impact on GDP, it is small. It does, as you said, hit labor-intensive sectors. But it is an overhang, right? And it goes beyond tariffs and numbers, etc. I mean, this is a strategic long-term relationship which is soured. And hence, I'm asking this question. To your mind, this drags on for how long, you think, Mark?
I don't think it'll drag on too long. I'm talking about weeks where they will come to the table and reach some kind of an agreement. Because, as you mentioned, the strategic partnership is very, very important to the U.S. And the U.S. will have to pull back in some area, whether it be definitely on tariffs, but in other areas they'll have to reach some agreement, because the relationship between the U.S. and India is very, very important to the U.S.
So you're saying a de-escalation with regards to these 50% tariffs, the secondary 25% basically is what is it? What's the issue here? That de-escalation it's a matter of weeks, according to you, Mark.
I think so. I think they'll make some agreement that will de-escalate this whole situation.
Yes. What is it? I mean, how is the U.S. Finance industry in that sense? People who allocate large sums of money around the world looking at this. If you remember, Mark, till last year, I mean, there was almost bipartisan agreement that between Republicans and Democrats in the U.S. that China is a big one. China is the rival, the big rival, right? And a lot of finance guys, fund managers, etc., they kind of sort of pull back from China. Under President Trump and under earlier President Biden as well. You don't think that kind of sentiment is there with regards to India, right? Because of what Trump administration and the White House is doing right now. It's very different, I'm assuming.
Oh, very, very different. You must remember, China represents a very, very substantial threat, a military threat. So that is definitely not the situation with India. India has shown that they are more interested in peace rather than in confrontation. So I think at the end of the day, China will continue to be a strategic concern on the part of the U.S. policymakers and Trump as well. So I think it's a completely different situation, which is why I think accommodation will be made with India. The U.S. and India will remain partners at the end of the day.
Yeah. And once this is resolved, right, you think this has done any, I don't want to use the word long term, but at least for the duration of President Trump's term now, remaining 3.5 years, you think it's going to remain a little tricky, a little tough? What's your sense, Mark? And this is not just about tariffs per se, but I mean, the entirety of the relationship.
I don't think so. I think you must remember, India is becoming a very important manufacturer of electronic products for the U.S. As you know, Apple is manufacturing a lot in India now and will continue to do so and probably increase going forward. So we're going to see an expansion of that kind of activity. You're going to see more investment on the part of U.S. companies in India. And, one of the positive aspects of this whole situation is that I believe that India, as you know, Modi has wanted to loosen up the incredible amount of bureaucracy that India has confronted the manufacturers in India with. And I believe that will begin to decline. India will begin to make some reforms in terms of the bureaucracy, making it easier for companies to come in.
Yeah, absolutely. Mark, you watched China for a long time. For the last 5 years, things were tense, right? Since the Galwan clashes in 2020 between India and China, no direct flights, all of that seems to be changing. Maybe, of course, in the backdrop are these Trump tariffs. China is tariffed at the highest rate. Effective tariffs, I think, for China are 42%. India's effective tariffs after exemptions is about 34%. But number one and number two. How do you see this relationship evolve? And if at least on the economic front, things can be normalized in terms of allowing Chinese FDI, access to markets, Chinese technology, for example, technology transfer. You think it could be a big one, or as we've heard from U.S. officials, top U.S. officials saying that they are surprised by what they're saying, what they're seeing right now, and they don't see this as a durable alliance, even, of course, as the U.S. imposes these tariffs in India. What's your sense?
No, I think policymakers in the U.S. realize that from a long-term point of view, China cannot be a partner with the U.S. They've got to continue to pressure China to open up their market to U.S. companies and to change their entire policy. But that won't be easy for China to do. India will be a much easier partner for the U.S. because they have basic principles of democracy in place. China doesn't have that. I think that's a very, very important difference between India and China in relationship to the U.S. So now the hope is that the Communist Party in China changes into a more democratically oriented party, but that's not in the foreseeable future. That doesn't seem to be the case, at least the way things look now. Whereas India is a completely important partner, a different partner to the U.S., a much more democratic, open society. What has to happen, I think, going forward is India will have to reduce the amount of bureaucracy and the restrictions that they have, not only in foreign investors, but in domestic investors as well. So once that is accomplished, and I think Modi is working very hard to accomplish that, not easy, when you think about the differences between different states in India, it's not an easy task, but that is going to be a very big game changer in terms of not only Indian development, but in terms of India-U.S. ties and relationships.
Yeah. No, you're absolutely right, Mark. What we're going to do, Mark, is stay with us. We're going to take a quick commercial break here. We're going to come back and continue this conversation. We've not even touched upon what markets are likely to do, in your opinion. So we'll do that on the other side. Stay with us. Well, we're in conversation with Mark Mobius here on another episode of Market Masters. Mark, before we get to the market, just a couple of things I want to clear out and get your views, right? Your view was U.S. tariff revenues will be large and sustainable. Deficits will be under control, and there's no reason for the dollar to fall substantially. Are those 3 points, you still maintain those 3 points with what has happened over the last couple of months?
Yes, I do. I think you're going to see the U.S. deficit coming down as a result of the tariff revenue. And both, you must remember also, there's been a lot of cuts in government spending in the U.S. That will be an important factor, but the most important factor will be the tariff revenues. And as a result, the U.S. dollar will get stronger. Well, you've already seen against some currencies, but for example, against the Indian rupee, the dollar is getting stronger. It won't be a substantial move. You must remember these currency moves, with a few exceptions, are not dramatic. You get 5-10% change, but for the U.S. dollar, that's a big, big change.
So sorry, 5-10% change lower for the dollar?
Higher.
Higher. So, Mark, you do realize this is a completely non-consensus view, right? everyone out there thinks, at least the mainstream research houses, funds, I mean, we talk to everybody and they say, well, deficits continue to rise and the dollar, I mean, the one strong view out there is for a weaker dollar, if I can put it like that. So this is completely non-consensus.
Yeah, I just don't see it. And I noticed that gold has moved up pretty dramatically, about 5% in the last few days. So that's a lot of people think, well, hey, that means the dollar is going to get weaker. But I don't think so. From a longer term point of view, the dollar will get stronger.
You're sticking to that that view. Absolutely. Mark, you know, the big reason why US markets have done so well is this entire AI theme, right? The large technology stocks. We are starting to see a little bit of wobble. NVIDIA, by the way, is about 8% of the S&P, just one stock, you know, on a market cap basis. Sam Altman recently said AI investments is a bit of a bubble. Do you sense that at all? Or you think, I mean, this is the apex technology of our times and I mean, it's the theme which will continue to drive US markets higher. What's your sense?
There's no question. AI is somewhat of a bubble in the sense that everybody is talking about AI as a big change, as a dramatic development in technology, but it's not. It's basically an acceleration of information flow of the speed that is possible by new chips coming into the market. But at the end of the day, there's no question that technology is going to drive what goes forward. And by technology, I mean not only chip design, chip development, but also automation, robotization of manufacturing. This is going to be the big change taking place going forward. And by the way, that's one of the reasons why the U.S. will be able to get a lot of more manufacturing into the U.S. market because of robotization. Obviously, labor rates in the U.S. do not compete with labor rates in other parts of the world, but when it comes to robots, a lot of the manufacturing will be able to be done in the U.S. So I think at the end of the day, it's not only about AI, it's about all the rest of the developments that are taking place in technology. And as you know, in India, Modi has set a target for India to do more design of chips. You know, I think the number now is about 20% of chip design globally is being done in India anyway. So I think more and more that is going to take place in India, and manufacturing will take place in India. And that will drive a lot of the technology improvements that we see coming down the pike, and not only in India, but in other parts of the world.
Yeah, absolutely. And design is happening.
Well, that is an interesting conversation going on with Mark Mobius. For the markets, things are very quiet. The Nifty is hovering around 24,600. On one hand, you've got Wall Street under pressure, Asian markets weak in trade. If you pull up, frontline Asian markets, Shanghai is down over 1%. The Japanese markets, that's Nikkei, lower by nearly 1%. Hang Seng too is struggling today. It's got a loss of more than about 0.5%. So we're weighed down by the weakness in our global cues, but that's being offset by the optimism going into the GST meet, which is why right now, at least, markets seem to be evenly balanced, just holding out with a mild positive bias right now on the benchmark. The Nifty is up 15 points, Sensex is up close to about a point. It's absolutely flat, 25 points up. Though individual stocks continue to do very, very well. Of course, the star today is TBO Tech after the company made an acquisition of a US-based luxury travel company, Classic Vacations. They will be spending $125 million on this particular acquisition. The acquired company revenues were $111 million, which basically means the company is making this acquisition at one-time sales. So that's been, a big mover. And with the gain today at about 1,500, the stock has finally gone above its listing price. The issue price for TBO Tech was about 920. It listed at 1,404. After that, the markets, the stock soared to levels of 2,000. It fell to about sub 900 rupees in April of 2025. And since then, it's had a fantastic comeback. This is the entire 1.5-year journey of TBO Tech since listing. And on the way down, it's Indus Stars, and we'll discuss that in greater detail. And that continues to be the stock under pressure, down more than 4%. Get into a break. On the other side, we'll come back with more.
Welcome back. You're still tuned into Trading Hour. A 60-point cut on the Nifty. The Bank Nifty too is seeing some cuts. It's been volatile in the last couple of trading minutes, and that's something we'll keep tracking. GST continues to be the big story, but we have to get stock specific now. Hormuz is here with us to put spotlight on top movers in the market. Hormuz, tell us more.
The benchmark indices are a bit choppy, but of course there are some movers in the broader markets in today's session, and TD Power is one of them. Is the biggest single day gain that the stock has seen since May of this year. We already had close to 15 lakh shares changing hands compared to a 20-day average of just close to 2 lakh shares. And courtesy of this move, the stock has also now nearing overbought territory on the charts, with the RSI now at 65 and the reading above 70 indicates that the stock is in overbought territory. Now, also the stock is at the start of 2020, the stock was at 27 rupees, and after this move, the stock is now from those levels to now at record high levels of around 555 is TD Power. The other mover today is Vimta Labs, and that stock is now extending its gains today, another 7% higher on the stock. It was up 17% on Tuesday as well, and this session today itself has already seen more than 70 lakh shares change hands compared to a 20-day average of just compared to 9 lakh shares, and the stock has gained in 4 out of the last 5 trading sessions has Vimta Labs. So that's been a good mover in today's session as well. Among the PSUs, Moil is the other one that has also gained in 4 out of the last 5 trading sessions. Of course, it reported its business updates, and based on which it is reacting 4.5% higher on very strong volumes, up 10% in the last 3 sessions. Today's volumes being the highest since May of this year, and we've already had 41 lakh shares change hands so far, and the 20-day average is just 1.5 lakh. And courtesy of this move, the stock has broken both above its 50 and its 100-day moving average, which is between 355 to 357. And to round off the list is Indus Towers, of course. Second day of losses today. The stock had ended at the lowest point of the day yesterday as well, and today itself we have had already close to 3 crore shares change hands compared to a 20-day average of just around about 20 lakh shares. It's been an underperformer this year, down around 30% from its 52-week high, and courtesy of this down move, the stock has been declining for 3 months in a row now. It has also turned negative on a year-to-date basis.
Okay, all right. Thank you so much for joining us with that list, Hormuz. Those are some buzzing stocks, some interesting names that are making major moves in the broader markets. Let's get in Apoorv Sheth from Samco Securities for a quick technical check on the markets. Apoorv, good morning. Thank you so much for joining in. What do you make of the market moves currently? What is the next important level to watch out for on the Nifty?
Yeah, thank you and good morning for inviting me, and thank you and good morning for inviting me on the show. Now, 24,500 is a major support on the weekly chart. So that until and unless that level holds on, I believe bulls have some strength in their power. There's a double bottom formation which is happening on the short-term charts. And the RSI is also developing a bullish divergence. So along with that, the market breadth is also oversold. So I believe that 24,500, 24,400 is a good level for the bulls. So currently is a good level to go long on with a stop loss of 24,400 for a target of 25,000. And amongst the stock picks, Navabharat Ventures, Nava, is one of our picks. So the stop loss for that would be 650 and target would be 800. It has recently witnessed a strong price and volume breakout a few days ago, and it is also holding in a falling market. So it's quite resilient, and the short-term charts are also looking good. And another stock is M&M. So on 18th of August, we had witnessed a very large gap up move on the Nifty auto index. So a lot of auto stocks had moved up after that. And M&M also managed to break out above the 3,200 mark. So that level is now acting as a support for the stock, which was earlier acting as a very strong resistance. So M&M can be bought at current levels with a stop loss of 3,190 for a target of 3,400.
Apoorv, thank you for sparing time and joining us today with your views on the index and on specific stocks as well. By the way, just before we take that break, just pull up Piramal Pharma. That stock is now at the highest point of the day, extending its gains from where it started off in the morning session, almost 8% higher now on Piramal Pharma, back above the mark of 200 rupees. is where the stock stands. Of course, the stock doing well on volumes as well. So 201 on Piramal Pharma, 8% higher on the stock. Take a short break. On the other side, we bring you a conversation with Ashwini Kumar Tiwari of State Bank of India on the GST, tariffs and a lot of other subjects. Stay tuned. We'll be right back.
Welcome back. You're still tuned in to Trading Hour on CNBC-TV18. Well, we've been talking about that big fall in rupee against the dollar. It is at a record low as well currently. So how does it impact some sectors, and oil and gas specifically, because this sector imports a lot in terms of gas, in terms of crude oil as well, and the stocks tend to get impacted by that as well. So let's get started with the top of the chain. That's the upstream companies. ONGC and Oil India, how do they get impacted? So basically, they are oil producers. So if dollar is getting strengthened, it is something which is positive for these companies. According to ICICI Securities, standalone EPS would rise by 1 to 2% for every 1 rupee depreciation against the dollar. So that is a positive for them. Additionally, remember, Oil India had also acquired Numaligarh refinery from BPCL. Any improvement refining margins from there, because they are also dollar denominated, this would be an upside for Oil India as well. For Petronet LNG, which imports gas, regasifies them, for them it will be in terms of a positive, because regas margins for them, they are US linked. So it will be leading to 1 to 3 rupees per percent increase in EPS for every 1 rupee depreciation. For Reliance Industries, it's a mixed bag. Remember, they import crude, LNG, ethane, but that will be offset by stronger realizations that will be seen in refining, because they export petchem and upstream as well. So it will be a mixed bag here, but if we talk about the overall impact, it will be limited to -1 to -1.3% for every 1 rupee depreciation that we see. Let's talk about oil marketing companies. Now, remember, in terms of refining, of course, they'll see better margins coming in because dollar is getting strengthened. However, it will be offset by retail margin compression, because that is somewhere we'll see an impact, because they will be importing crude in dollar denominated terms, and the selling price will not be changed accordingly. So EPS impact could be 11% for every 1 rupee of depreciation that we are seeing. Again, a mixed picture, but the overall impact is around 11%. For CGDs, now remember, they import LNG, which is liquefied natural gas. It is a limited pass-through that they see as well, because it could impact their volumes if they pass through the entire dollar strengthening that they are seeing. So EPS impact could range from 4 to 11%, depending on how much LNG they import. Like Gujarat Gas imports the most, so there could be a bigger impact there, followed by IGL and MGL. So this is how the picture would be. If this record low levels of rupee continue, it could start hitting some of them, while it could be positive for the exporters and for those who have dollar-denominated margins.
Okay, that's about the oil and gas space. Let's move on and talk about Indus Stars. That's the stock under pressure. This is because the company has announced its global expansion. They will be getting into Africa, and they will start by 3 key markets. One of them is Nigeria, the other one is Uganda and Zambia. Now, the street is disappointed because the street was hoping that the company will start paying out dividends. You know, this was a cash-rich company. They used to pay dividends for a while. And then because Vodafone Idea started struggling and there were overdues, receivables from Vodafone Idea, Indus Stars had stopped paying dividend. But now, as you know, the Vodafone Idea, about a couple of years back, had done that QIP. There was that FPO. They raised some money. Indus Stars started making good on its receivables. Even the past receivables were cleared. So therefore, Indus Stars once again became in a comfortable free cash flow position. And therefore, the street thought that now is the time. Indus Stars will go back on its capital allocation, which is repay 100% of their free cash flow and start giving out dividends. So the street was very hopeful on that front. But now with this global foray expanding into Africa, this dividend payout is going to be questioned. One, will there be a delay to that? Delay to when they'll start, reinstating the dividend? And two, will the amount also get cut? Will the capital allocation policy need to get revised? So Street is concerned, which is getting reflected in the stock price today. CLSA has cut the target price to 520. They say we had expected the management to focus on improving the company's capital structure by paying out high dividends, while the board is committed to the reinstatement of distributions, but with an unjustified delay in dividends. Citi, though, is still bullish, 460. In fact, both of them, even CLSA's target is 520, Citi is at 460, the current market price is 316, so it's a lot of upside from current levels. Citi believes the current concerns are overdone, current valuations are favorable, and crucially, I think the most important point that Citi makes is that their bear case scenario is a valuation of 300 rupees, and Indus Stars is very close to that current market price, which means downside from here is limited, according to them. So that's the story on Indus Stars. This dividend hope is getting pushed forward now.
That's not something that the street is very impressed with, and it shows that the stock is falling on very heavy volumes as well. So Indus Towers among the top losers in the broader markets today. Slight recovery from the lows, but still 4% lower on the stock and extending its losses from its 52-week high. But the big news today is, of course, the GST Council meeting that begins today, and the rejig in the rates is expected to drive a surge in consumption. Now, to understand the impact of the proposed cuts and also to understand how tariffs will impact banks and others such segments, our colleague Ritu caught up with Ashwini Kumar Tiwari, the Managing Director of Corporate Banking and Subsidiaries at State Bank of India. Listen in to that conversation.
We see a lot of positivity, especially on the retail side with the GST cut. We hope a lot of cars will get sold and a lot of other personal goods will get sold, leading to demand for personal loans, etc. So good possibilities of credit growth going forward.
Well, while that may be the case, Mr. Tiwari, but in the second quarter, as spending gets delayed in anticipation of lower rates that are yet to come, do you see some temporary impact in the second quarter growth numbers, as people wait for these cuts to happen and perhaps delay their spending until then?
So some waiting may be happening, especially on the large tickets like auto, etc. But what we are not seeing any changes in the mortgage portfolio, which continues to do well. The credit growth is fine. Overall, we see no significant impact on our loan growth. There may be some individual segments here and there which might be. So for us, mortgage is doing well. SME continues to do very, very well. Last several quarters, it has posted growth rates of above 15%. So overall, we see no impact of this anticipation of GST cuts so far. Whatever it's happening is to the localized industry level, maybe there is some impact on sales.
All right. Even the recent GDP numbers, we've been positively surprised with the 7.8% print. From SBI's vantage point, does this feel broad-based on the ground as well? I mean, where are you seeing actual green shoots?
So see, part of this, while this is a very good number and it probably beat a lot of expectations on the upside, part of the reason also is some front loading of exports, etc., which got done because in anticipation of the incoming tariffs and all. How much of that is, we will know only when more details emerge. But on the ground, as I said, we see the credit growth steady. We are not seeing any spurts either on the upside or any downward trends, etc. We see a steady thing. On the CapEx side from corporates also, we are now seeing a lot more intent, more importantly, more proposals. And as I think in the first quarter earnings call, we had given out a pipeline number of 5 lakh crores, including sanctions and those under discussions. And we are seeing a lot of that getting converted now also. So I don't see a lot of either up or down movement as far as our book goes.
Mr. Tiwari, just to reconfirm, the pipeline figure for these corporate loans that you had given us earlier, was that 5 lakh crores or 7.2 lakh crores was the total figure, as we understand?
So the 7.2 lakh crores was 3.45 or 3.4. That number was the under discussion. And the remaining is both unutilized credit limits, which I had not mentioned now. So the remaining portion is the sanctioned but not utilized working capital limits.
Okay, got that. Let me quickly come to the flip side. With the higher US tariffs on India and the narrative adding a lot of uncertainty, what could be the impact on your bank? Which borrower segments are you going to be more watchful of? And how exposed is SBI's loan book to the industries that will get affected because of these higher tariffs?
So we have done an analysis. Well, I can't give you exact numbers, but the overall impact on our book is not significant. There are some units in the industries which are more impacted. For example, we know all these industries, these gems and jewelry, the seafood, especially shrimp. We have the textiles industry, we have engineering goods, we have some specialty chemicals. So 5-6 industries are the major ones impacted. So while we have exposure to some units in each of these, but the overall impact on our book is not significant. One other thing is that many of these exporters are cash rich and have not been borrowing heavily, even if they have lines available. So on balance, we don't see too much of impact on our book directly. On the second order effects, if any, we will have to evaluate that and as we go forward.
Mr. Tiwari, when you say it's not significant, your exposure, should we assume it is less than 10% in single digits?
No, we can't give you a number, but it is quite less compared to the overall book size which we have. It's not significant in any significant manner. And many of those who we are talking to are also... Sorry, many of those who we are talking to each of these large players especially, they are also looking to diversify, looking to get alternate places. Many of them already have some setup either in the Middle East or in other Asian countries from where they look to supply. So they are trying to find ways in which to lessen the impact of the tariff as well.
But just sum up this credit growth conversation, sir, with the tariff impact, investment decisions getting delayed, all of that, and your own corporate loan book, growing in single digits in the previous quarter. How soon do you expect to get back to double-digit credit growth? And do you retain that overall credit growth guidance of 12 to 13% for the fiscal, or could that be slightly lower?
So 12 to 13% is we still retain that. I mean, unless something goes drastically wrong, in which case it could come down a little. I mean, you are aware that the last quarter numbers for all scheduled commercial banks is somewhere in the range of 10.5%. So that has come down on an industry level. But we retain the guidance, and the reason for that is that on the retail side, we continue to see strong growth, and we are focusing now also on the personal loans, which have not been grown well.
India's largest lender retaining their credit growth guidance of 12 to 13% for this year. Absolutely directionless on the index right now, and a less than 100-point range is where the Nifty is, still hovering between that 24,550 to 24,650 range in today's trading session. Take a short break, put the spotlight on the crypto markets on the other side with Manisha Gupta.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. You're still tuned in to Trading Hour. As promised, let's shift focus to the crypto space. Manisha Gupta is joining in now. Manisha?
In Crypto Corner today, we are talking about tokenized gold. Well, tokenized gold market is at a record $2.6 billion right now. The surge clearly comes in on the back of the gold prices surging at a record highs of around $35-50 an ounce. And because of this strong demand for gold, there is also a strong demand for tokenized gold, as we have seen in the international markets. So when you look at the tokenized gold, it represents gold-backed crypto tokens, which is tokenized gold, which is digitized, and it is minted on blockchain. Tokens are backed by an equivalent amount of gold as a back end there, and also it is held as custody by the issuing authority. Most gold-backed tokens are built on ERC-20 standards, which is on Ethereum blockchain. This is also done via smart contracts. And when you look at tokenized gold accessibility, well, one, it is fractionalized ownership. Second, it is easier trading, and it can be used for decentralized finance as well. So it gives you a lot of advantages in that sense. And then gold tokens are transferable, they are tradable, they can be used on centralized and decentralized exchanges also. And some platforms also give you facility of exchanging this for actual gold or also converting it into fiat currencies. Well, when you look at the blockchain technology benefits, the storage cost is eliminated. There is safety and security when it comes to blockchain, and it can be really brought at a very, very fractionalized way, because when you look at the gold prices itself, 1 kg is for more than ₹1 crore now. So buying it smaller in smaller denominations and buying it on blockchains with crypto backing is something that market sees as very, very positive. Let me also take you through the two largest gold-backed tokens. One is Tether's XAUT. This is the biggest in sense of market cap as well, at around $1.3 billion. And the minting for the month of August in this case has been really the highest. The other one to watch out for is Paxos PAXG. The market capitalization for this one stands at around $983 million. And then there are some other gold tokens as well available, which the markets seem to be trading quite strongly at this point in time. It is Quorium, it's Kinesis Gold, Vera One, Novem Gold and Gold Dow as well, which have done quite well in the previous quarter and in the last 1 month as well. With the way the gold prices are increasing, the gold-backed tokens doing quite well too.
Thank you very much for that. Get into a break. On the other side is our big story. Stay tuned. Don't go anywhere.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. On to the big story of the day. The GST Council is set to meet today and tomorrow to discuss the centre's proposal for a simplified two-slab structure. Timsy is at the Sushma Swaraj Bhavan where the GST meeting is taking place. Timsy, over to you.
Well, yes, as you rightly mentioned, the high-powered GST Council meeting to discuss Union's proposal of shifting to a two-slab structure of 5% and 18% is underway. We heard opposition states keeping a clear demand that their revenue protection and ensuring that there is no profiteering being done by industries. All the benefits of reduced rates should be passed on to the consumers. These are the two key demands. And remember, revenue protection is the only key deal maker. That's what sources are saying. Center proposal on the table, and what is going to make the deal, what is going to pave way for this two-rate structure to become a reality is going to be the promise to the states on revenue protection. We are understanding from sources that not only just opposition-ruled states, even some BJP-ruled states are likely to face huge revenue losses for which this revenue protection is required. More crucially, we have to see how soon these rate reduction process actually kicks in to boost the consumption. 5%, 18%, 40%, 40% only for demerit goods. And remember, all common use items, toothpaste, soap, shampoo, biscuit, everything coming down from 18% and 12% bracket to 5%. Aspirational goods such as consumer durables, we've seen televisions, air conditioners, etc., which currently attract 28%, are likely to come down to 18%. Overall, a mass consumption boost is being pegged through a simplified GST structure. But the only bone of contention, compensation cess levy likely to end by end of October, and what could now give the revenue protection to the states. Apart from that, another key proposal on the agenda, reduction of insurance premium of health and life insurance, including reinsurance, including the family floater programs, which likely is going to have about 9,900 crore rupees of annual revenue loss. So overall revenue loss position is what the states had asked Centre for. It is likely to be tabled in this council meeting. Also, states had demanded that there should be an additional levy. A carve-out needs to be made to ensure that there is an additional levy within the GST law, whether states agree to this or not, whether Centre agrees to this demand of the states or not. Everything in this power-packed GST Council meeting, which we are tracking.
Okay, all right. Thank you so much, Timsy, for joining us with those details. The markets watching out for what's the outcome. And of course, this is the big story that we are tracking today. But with that, we'll wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next.